Rohr here with an early, concise highlight on Tuesday, July 8th, 2014. And very interesting that on the macro background, things are continuing to weaken. And looking at the actual trading activity to see how the bad news is not translating into good news anymore, maybe too much bad news for the equities. We're looking at the short-term charts of the U.S. S&P 500 future. Pardon me, 60-minute on the left, 30-minute on the right, indicators below. And after pushing out on what was an upside acceleration above 1971 on the weekly channel last week, that level of the top of the channel was up to 1975 this week. So as of Friday's close, it looked like this market might just be ready to continue the acceleration. But in the event, the gap lower with a high of the day and so far high of the week, right around 1975, is a bit troubling. It may look like the employment number and the market response was a bit more of a last hurrah than a new dawn for the equities, especially with other equities weak and having been dragged up by the U.S. Now, slightly below that, at about the 1973.5 level, we also broke down out of the aggressive upward channel from the last test of the overrun objective at 1938 to residual support in the 1935. And the key now, as far as we see it, is twofold. One, on a very short-term basis, the Wednesday close before Thursday's employment report response gap higher was 1967.70, and so far that gap has only been closed and held. After an upside additional runaway gap of sorts, if the gap is held, it's just filling in the support and removes a little bit of the upside momentum. However, should the market start closing back below that gap, especially on the daily charts, we're going to see that as exhaustion, which leads at least to a test of the next lower support, which is the overrun daily downside closing price reversal, and it's at that time aggressive channel down break back in the 1953 to 55 area. And of course there is a gap back down there from the gap higher on last week Tuesday that served notice on the bears. In spite of weak news, the equities were ready to push higher last week. And that pretty much does it for the short term, because the short term MACDs are not near any kind of critical level or giving critical signals. And while the short-term stochastic turned up on the stabilization yesterday, the hourly stochastic looks like it might have a bit more downside. And shifting over to the intermediate term picture, we wanted to leave this horizontal cursor up here to show you the 1975 top of the channel this week. And that relates to the oscillator resistance at 135 over the 41-week average. We're rounding the 41-week average up to 1840, so we're able to talk about 135 over being also right in the 1975. These have been out of sync for a little while, just slightly, for $5 or so, but starting now, the improvement in the 41-week average leads them together, making this a really big level for later this week. And you can see all the support back in the mid-1950s, not just from that overrun reversal from 2 weeks ago on Tuesday that the market overran last week, and this was the reversal from a week ago Tuesday. 2 weeks ago today, the market overran last week, but also from all the congestion on both the daily chart and on the weekly chart. And that pretty much does it for the intermediate term view of the S&P.